Guys, welcome back to Key Knowledge 2, second video of this series in Unit 2 Outcome 1, the legal and financial considerations. And today's video, we are looking at the financial requirements when we are establishing our business. So as per usual, let's look at the study design for this outcome. You can see it's shorter than most, only 5 key knowledge dot points. Like I said, this is the second of the 5. And this one, it says the importance of establishing bank accounts, financial control system, and record keeping strategies. So although this is about financial requirements, it actually gives us our script of 3 different things that it wants you to know about. So again, as per usual, it kind of simplifies things for us. So what's this one all about? Always start with this, just sort of what are we going to be talking about here? So look, when you're a new business owner, there's a whole bunch of different financial requirements that you need to be aware of. But you also need to be able to monitor the money coming into and going out of the business as well. Okay, if you don't have some kind of financial systems in place, you're not going to have a clue what your financial position is. And at the end of the day, you're running a business to make a profit. So it's really important that you understand how much money is kind of coming and going so that you know if you are making a profit or not. Because if not, then the business is doomed to fail. So the study design script, as I just said, it gives us 3 points. So this video is going to just focus on these 3 things as always. So the importance of establishing bank accounts, the importance of establishing financial control systems, and the importance of establishing record keeping strategies. So we are going to take those in turn. So starting off with that first one, the importance of establishing bank accounts. Right, the key here is you have to set up a separate bank account for your business. Okay, so although as a business owner, even if you're a sole trader, you'll have a bank account. You have to set up a separate one for the business. Okay, you do not use the owner's personal bank account for the business. Why? A couple of reasons. If you use the same account, it's going to be hard to keep track of, business income and expenses, separate them from personal. So your personal and your business income or income and expenses are all going to be mixed up. It's hard to kind of track either of them. So that's reason number 1. Reason number 2, when it comes to tax time, paying your taxes, you really need to know what belongs where. You need to know what income and expenses are to do with the business and separate those out from the personal. Okay, so 2 kind of key reasons why this is very important that you do this and establish a separate bank account. Now, if the business is set up as a company or a partnership, it's actually compulsory to have a separate business account. So if you were operating as a sole trader, it's just advisable to do this. I mean, you'd be crazy not to, but it's not a legal requirement. But if you're going to be operating as any kind of company, private limited company, public listed company, or a partnership, you have to legally have a separate business account. So again, really, really important distinction to be aware of. The second thing in our 3 points from the script that study design says we need to talk about was the importance of establishing financial control systems. All that means is processes and procedures that we use to monitor and manage the business's finances. And in doing that, that also kind of helps us prevent errors and also fraud. Fraud more so if you're employing other people in the business who have access to your finances. So if we have some financial control systems in place, it helps you manage the money, but it also helps you kind of helps avoid making mistakes with the money in the business, but also helps people potentially stealing money from you if they have access to the money. These financial control systems basically give business owners an understanding of all of the financial aspects of their business, and that also helps them to make informed decisions about the future of the business as well. Okay. Budgeting and auditing are 2 processes that we use within a business. Budgeting is this idea where we're estimating our future transactions. So we're thinking about, budgeting for the following year. What we're doing is essentially guesstimating how much income we're going to make, and we're guesstimating, what our expenses are going to be. So that's what we mean by budgeting. And auditing is the process of just making sure that we go back, well, not us, other people generally, auditors, who are a type of an accountant, that go back and check and verify that all of the financial information that you're recording is true, correct, and accurate. So that's kind of a legal process. Especially if you operate a business, you have to have that. You have to have your books audited each year. So auditing is the idea of verifying, checking that everything is true and accurate. Presents a true picture of the business's finance for all intents and purposes. And then the third aspect of this key knowledge dot point was the importance of establishing record keeping strategies. This is methods used to track all of the financial transactions of the business over a period of time, essentially. And it's important to do this because it allows you to track all of your transactions. So in other words, the money coming into the business, the money leaving the business. It provides proof of transactions when it comes to arranging tax and sorting out how much tax we're going to have to pay. It allows those audits I was just referring to happen. And it provides accurate information for decision-making purposes. Okay. All of that is important, but I guess most importantly, the ATO, the Australian Tax Office, requires a business to keep a written record of all transactions for 5 years. So basically, if you're running a business and you do not have a record of all of your transactions over the previous 5 years, you've opened yourself up potentially to prosecution and some kind of legal action. So whilst all that other stuff is, kind of important, the legality around this, the absolute importance of doing this, because the law says you've got to keep 5 years worth of records. So how do businesses do this? What system do they use? Basically through what we call a cash book. Okay, it's called a cash book. It doesn't have to be a manual physical book. It would have been in the old days. These days, much more common to be some kind of electronic book or a piece of software, essentially. This is a really, really simple form of record keeping. And then as the business becomes, grows and becomes more complex, then other things will be added on and the reporting process and record keeping process will become more complex. But a very simple cash book is the simplest way to do this. And MYOB, mind your own business, is, I would imagine, must be the market leading piece of software. So a lot of small businesses, you just buy this software, MYOB, and it allows you to do this. It allows you to log everything coming in, everything going out, and you're kind of covered for all eventualities, all of that stuff we talked about, the reasons you need to do this. If you're operating with MYOB, that's all going to be covered for you. And that's all we need to talk about for this second video, guys. So that's your financial requirements covered off. I will see you back for the third video in the series, which I believe is on suppliers. So I'll see you ready for that one. Cheers for now.